Good afternoon. This is, or I should say, good morning. This is Friday. It is time for Risk and Rewards. John authors in isolation over in London, still great us with
Yes, it is the afternoon here, and in fact, it's already dark. It being this in London, so yes.
and I'm Lisa
Agree with you.
Bromwoods here in New York, and it's December, and we got a whole bunch of data this week, particularly today with the CPI print. But I want to take a step back before we get into the granularity of it.
Yeah.
This week, we got two readings that were historic with respect to the Fed's dual mandate. With employment, you saw the lowest number of initial jobless claims going back to 1969. And then today, we found the hottest CPI print, yes, widely expected, going back to 1982. John, there is a takeaway here, but it does not seem to be the market's takeaway.
No, the takeaway really is that we already have emergency measures. We still have emergency measures in monetary policy from the Fed in terms of sparking inflation. The Fed is doing the things that you need to do to beat deflation. And that would appear to be totally, utterly, indefensibly wrong. It's a remarkable state of affairs.
This morning, Jim Bianco of Bianco Research was on Bloomberg Surveillance, and he said the Fed made a monumental, a historically faulty call when it came to the trajectory of inflation this year. They thought that it would start abating, that it would be transitory. They have now abandoned the T word, and it seems to be persisting. And it's unclear whether the underlying inputs really will roll over that quickly.
Yeah.
And yet people still seem to think that the Fed has inflation under control and that it's just until next year that things will roll over. What's your sense? Go ahead. What's your take on that?
I mean, some of the today reaction is because there was this possibility of passing the round number of 7% on headline CPI. And a lot of people were working on the assumption of if it's above 7%, that's terrible, risk off, anything else, risk on. I'm not defending it, but in terms of the short-term reaction, there was some degree of relief that it wasn't even worse. Beyond that, though, I am quite concerned that people are still as relaxed about this as they are. There are a few good reasons why there will be some of the tailwinds behind inflation will reduce for the next few months. Most obviously, the base effects caused by the oil prices, by gas prices are up more than 50% over the last 12 months. They're not, we hope, going to go up another 50% over the next 12 months. So there are one or two genuinely transitory reasons why the headline number should come down a bit. There's no reason to think that it'll come down anytime soon to the Fed's range of within 1% of 2%. That's a long way off at the moment, and there's no particular reason to see that it'll get there anytime soon.
Which is interesting that the 10-year yield went from 1.5% today to currently, I believe, about 1.44%. It has declined by 6 basis points after the fastest read of CPI, with inflation at 6.8% year over year, going back to 1982. Just for perspective, I looked up where the 10-year yield was in 1982. It was 14.7%. It is 1.44% today.
There is this suggestion. A year ago, there was it was quite popular to suggest that Jay Powell was going to be the inverse Volcker. If you remember the Jackson Hole last year with the introduction of flexible average inflation targeting and the idea, yes, I am actually going to jolt some inflation back into the system in the way that Volcker jolted it out of the system. I don't think anybody quite expected we were going to get quite such a perfect mirror image of Volcker in '82 and Jay Powell now. It's obviously, if you're a central banker, that's not a comfortable place to be. I had one of the most aggressive pieces of comments I've seen in the last few days comes from a guy called Mike Howell, who's close to where I am now. He's a former Salomon guy based in London, who runs cross-border capital, and his comment was, sadly, we don't trust Jay Powell to be another Volcker, but we're rather worried that Joe Biden could be another Jimmy Carter. So that was quite a concerning point of view, but you can see what's going on there with, obviously likening Biden to Jimmy Carter is provocative, but given the way politics works in Washington at the moment, it's going to be difficult for anything from the administration to be particularly coherent.
Let's take it away from the politics for just a second
Yeah.
and go to what the underlying components of the CPI report showed.
Yeah.
I think it was interesting. Sure, it's definitely coming from oil, also food, which with CPI at, I believe, 6.1% year over year, which is the fastest pace going back to 2008. But then you go to housing appreciation and rent appreciation, which is running at the fastest pace going back to 2007. Used cars and used, auto parts, you're seeing also climb at some of the fastest paces on record.
Yes.
And this comes even with hard comps, right? Even with
Yes.
some of the comparative evaluations from very close to pandemic era after the stimulus checks were sent out. What I've been looking at is wages. How much are they keeping pace? How much can that keep pushing things forward? And by some measures, real wages are still deeply negative. In fact, they went more negative in this last read. But if you dig beneath the surface, the lowest income earners are actually seeing wage gains. They're seeing positive real wage growth. And that should ultimately be a positive, right? This is what we want to see, but it will also help continue some of the inflationary reads that we're seeing now.
Exactly. This is in terms of when the argument was being made that it was time for Powell to be the inverse Volcker. This was exactly the idea. We'll have a bit more inflation, and that's the price we'll pay for addressing some of this dreadful sluggishness, some of the really quite cruel inequality that has led so many people to have their living standards really dragged behind. So nobody is saying that it's a bad thing that some of those inequalities are being addressed. I mean, if you look at the Atlanta Fed wage tracker, it is quite dramatic how all the ways you slice and dice it, because they break it down a number of different ways. It's the groups that were previously getting the worst deal that are now getting a better deal. The young are getting vastly more pay increases than the over 55s. Women's wage rises are ahead of men's, which I'm afraid to say isn't common, but it's a clear effect now. And people in the lowest quartile are getting far faster wage rises than those in the upper quartile. So you do. There was the general expectation that the rising inequality and the disinflation, the deflation of the last 10, 20 years were linked. And so it now appears. If we want to correct some of those problems that have been hurting society so much, it's going to cost us in terms of rising price levels.
So what does the Fed do with this, right? Because on one hand, this is a positive trend in terms of employment, in terms of the wage distribution. And basically, in some ways, this is an equalizing factor, because if the lower wage workers are getting real wage gains and the higher wage workers are getting real wage losses, essentially, when you take a look at inflation, they're not going to cry about that. However, the problem is a sustained aspect of this. And one thing that you brought up in a column that I know hasn't been published yet, but I find one of the most important things that you've written is this faith-based economics. The fact that all of these presumptions that economists and analysts and fixed income investors have not come true. And they keep pushing back their time frame for when to count the data. And I was even speaking with one bond fund manager today who was saying the same thing. This print really won't matter. We'll see what happens in March, in April, in May. When does the data matter? And at what point are we sacrificing, the forest for the trees in understanding what actually is happening with inflation?
Okay, that's that. I mean, I find that quite alarming. Your comment with the bond strategist. The piece you were mentioning is we've done a retrospective for the full year on the indicators that I've been following weekly, and that's in the form of a heat map. And it is, to be fair to those who got this call wrong, it does show that this was a very difficult call. There were very few reasons for concern anywhere in the data back in January, and then the April inflation number was the one that really scared people, but that really was driven by transitory factors. In retrospect, it was necessary to do an awful lot more to head off broadening of inflationary pressure. But this was a weird situation, obviously caused in part by the pandemic, and it's wrong-footed people. what bothers me is that there's no particular reason to think that the end of the pandemic, whenever it's well, there's beginning to doubt how clean cut an end there's ever going to be to the pandemic. But there's no particular reason to assume that much of the effects we've seen would reverse. In the case of shelter inflation, which you mentioned, that tends, rents tend to follow house prices with quite a long lag, and house prices have gone up an awful lot, and rents are a third of the entire CPI. And that is, it's still not as eye-catching, but as you said, we're now talking about the highest increases in more than a decade. Even shelter inflation has already broken out of the extreme low inflation paradigm that we've had since the crisis. So yes, I am alarmed by the degree of denial. I think I think it was reasonable. Plenty of intelligent people were defensibly caught wrong earlier on because this was a very strange set of circumstances, to put it mildly, that we've all been living through. I don't understand how people can be relaxed about it now. I just that blows my mind.
I have a theory that has been a little bit concerning to me. I'll just put it out there since it's just you and me talking and no one can hear us. That, a lot of people will justify this conviction that the Fed is right and that next year things will moderate substantially by saying, look at the bond market, right? The yield curve has been flattening, and it basically shows the Fed can contain inflation and that nobody's that worried about longer term runaway inflation. This is confirmed also by the University of Michigan Consumer Confidence Survey that came out today. It improved, which is a great thing. And also it showed that those long-term inflation expectations remain stable.
Yes.
3%. I wonder if the message from the bond market has gotten so vastly distorted by the fact that we've been basically sucking up all of the extra debt purchases, debt issuance by the U.S. government with the central bank's purchases. Yes. And, if you look at their balance sheet, it's doubled since the beginning of the pandemic. It's, getting close to $9 trillion. So I don't understand, and I don't get a sense of whether anyone fully understands the effect of the balance sheet on the yields, on the dynamic there. Yeah. And frankly, this is being done globally. So are we getting the wrong signal from the bond market that is inaccurate in terms of a reflection of the curve of real inflation and how that's going to sort of wreak havoc in some ways over certain sectors of the economy? And this is something that I was struck by Bill Dudley, the former New York Fed president, who came on and was talking to us. And he said he's very concerned about this. And that's why a lot of people are looking to next week, to the Wednesday's Fed meeting. Are they going to mention the balance sheet, letting it roll off? And could that potentially be more disruptive than anything they do with respect to rate hikes next year?
I think it probably answer to that question, yes. I think they do have to think very carefully about what they do with that very, very, very bloated balance sheet. And there is a very great risk that is going to cause problems because the ability to roll over debt is almost more important than the rate at which you do it. If there is less supply of liquidity, lots of corporates, lots of companies are relying on being able to roll over their debt very swiftly. And therefore, that could, again, some of the people I've talked to are more concerned that reining in the balance sheet might be a more direct, successful way to tighten conditions, but it's one that is going to be very difficult to do without causing damage. I think getting back to Bill Dudley, who, after plugging my piece for Bloomberg Opinion, let's plug Bill Dudley's piece that he very kindly wrote for us. I would take what he wrote. I am surprised that his piece for us didn't have more of an influence on market perception, because this is a week when the current governors of the Fed are in purdah. They're not allowed to talk publicly because the FOMC meeting is coming up. If a guy who is still in very good standing with them, who was chairman of the New York Fed until whatever it was, a couple of years ago, says quite as clearly as he does, you're going to be surprised next week they're going to really try to shift their expectations. I really think the market is wrong about this. If I were actively trading bonds, I would read that and go, oh, I'm wrong about this. I'd better do something. Everything about, I haven't spoken to Mr. Dudley about this, but everything about that suggested that we really should take it very seriously. If this man at this time is saying this aggressively, be prepared for the Fed to surprise you next week, you should immediately prepare for the Fed to surprise you. And that's, as you've said, is the exact opposite of how people are responding since that piece came out.
Especially since Bill Dudley has actually been right for a lot of this year in terms of the trajectory of both inflation and how much the Fed has changed some of their prognostications and expectations. We're completely out of time. Is there anything that you wanted to mention, though? Because I feel like next week is going to be a seminal week where we take stock of a year that was extraordinary in every way. And the central bankers from the Federal Reserve, the ECB, and Bank of England will all come together and have to say something after getting some of these very hot inflation and very hot labor market reports. What are you most looking for?
It's fascinating. Given my current predicament sitting here in London, I'm very interested to see whether Omicron really does change anything. Certainly the Bank of England here have put out word that they're going to that Omicron might yet cause them not to actually, they've got to the stage where people expected them to hike last month, if you remember. If it weren't for Omicron, I think it would be a virtual certainty that they would hike this month. Are people nervous enough about Omicron, which doesn't seem, famous last words, to be anything like as scary as it was when we first got news of it? Are people going to take Omicron seriously? Just bearing in mind, it was COVID that churned up all these different difficult conditions that we haven't been able to deal with. So that's one thing: is can we already forget about Omicron? And if we can, then we're going to get a bunch of hawkish surprises next week, I think.
John Authors, have a wonderful time in isolation, and then have a better time on your trip to London. To everyone else, in case
don't leave me on my own, don't, Lisa. Bye.
Have a great weekend. Take care.